Right, good afternoon everyone, and welcome back for this afternoon's session, which is on the next steps for renewables, focusing very much on subsidy-free renewables. I'm Richard Howard, I'm the Head of Research at Aurora Energy. Very pleased to be chairing this panel debate this afternoon. We need to try and keep lots of energy going, I think, this afternoon. We're getting towards the tail end of the day's proceedings, so let's try and keep it high energy panel. I want, no comment is too provocative. I'll try and ask you a few questions to get us going as well. So as you can tell, renewables has been a big theme throughout all of today's discussion, actually, in the discussion of the global energy transition. My colleague Mateusz gave us a lot of data and analytics around that, and I think that some of the numbers he presented around the size of the prize, the 180 billion euro figure investment opportunity for renewables across Northwest Europe, really tells you an awful lot, and one third of that overall number is around subsidy-free renewables. So this is very much something we think will be happening over the next few years. But the purpose of this section is really to dig into that a little bit in more detail and also hear from some of the leading companies active in this space. And the way I wanted to frame this discussion was to really think about the three key factors that could make or break this subsidy-free renewables opportunity. Let's see if this works. It didn't work. Oh dear. Could we advance to the next slide, please? All the talk of blockchain and we don't even have a clicker that works. There we go. Oh no, now we've gone too far. Okay, brilliant. Sorry about that. So the three key factors which could make or break renewables, in my mind, I put down some thoughts here. Firstly, on the technology side, will we continue to see the sorts of cost reductions that we've seen in the last few years for renewables? That's question number one. And that needs to come through both in terms of capex reductions, efficiency improvements, but there are factors that could constrain this, for example, planning restrictions on larger wind turbines. The second factor, which we really need to think about in terms of make or break factor for subsidy-free renewables, is about finance. Mateusz has already outlined some of the discussion points around this, but really the key question is whether developers and investors in subsidy-free renewable projects can actually get comfortable with taking merchant risk and with the risks around price cannibalization, or to put it another way, whether there's something that they might be able to do to de-risk that, either whether that's through a PPA structure or through other business models such as co-location with storage. But a key challenge around the financing side of things. And then thirdly, the third point is around integration. If we have a very high renewables world, how will balancing work? There'll be a huge need for balancing. We need to think about how to ensure there's enough capacity on the system, and we also need to think about how to keep the system operable overall, and think about grid integration. So just to go through these in turn. On the cost side, this is our data, our sort of Aurora central case, if you like, for how we see the capex evolving over time. We've already seen huge reductions in cost, particularly for offshore wind and for solar PV since 2010, and Mateusz's analysis spoke to that as well. But we think that we will continue to see significant cost reductions driven both by further learning by doing, but also global deployment and economies of scale, both in overall production and also in the size of renewable projects getting bigger over time. So a range of different factors that can continue to drive down costs. On the financing side, the key thing to think through is around cost of capital. So as I said, this is really a game around developers and investors becoming comfortable or not with merchant risk and with price cannibalization. This chart shows some analysis we did looking at the German market, looking at onshore wind in Germany. And what we looked at was what's the levelized cost of energy of onshore wind with a sort of a fairly normal cost of capital of 9% or a 13% as an alternative if investors fail to get comfortable with the idea of taking merchant risk and get worried about price cannibalization. And as you can see, this really pushes back the date of the first deployment of subsidy-free renewables if we can't get comfortable, if developers and investors can't get comfortable with the idea of taking merchant risk and therefore apply a very high risk premium to that. Lastly, I mentioned res integration. This comes in a number of different forms. There's a load of different issues that we need to think through here. But as you have more and more renewables on a system, you have to think about how you're going to balance that system. And you also need to think about how to ensure there's enough capacity on the system. You also need to think about system operability. In all three cases, these are challenges in terms of how to create that high renewables system. There are also opportunities for subsidy-free renewables projects to play into different markets. So, for example, we already see onshore wind in the GB system participating in the balancing market, providing downward balancing. There's talk, as I think Claire Perry mentioned in her talk, of potential participation of renewables in the capacity market in the future. We need to think about the de-rating would apply to that, but in principle, it's an interesting idea. And there's also been trials, and successful trials, that have shown that wind projects can provide frequency response, and there's an offshore wind project in GB that's already successfully done this. So these all, in all three cases, these are both challenges in terms of the overall system, but they're also potential opportunities for renewables projects to access new revenue streams in a different way, changing the nature of the renewables business model with revenue stacking rather than a pure selling kilowatts model. So as I said, I think those are the three big challenges. What I'd like to do is bring in my four panelists, who will hopefully add a bit of flesh onto that, or maybe take it in their own direction. Let's see. So we'll start with Juliet Davenport, who's CEO of Good Energy since it was created in 1999. Good Energy has its own fleet of renewables projects, but also buys renewables output from, I think, 1,000 different projects around the country, and obviously sells that to both domestic and industrial consumers in a green energy tariff. So, Juliet, you've built your business around the kind of renewables proposition, but I suppose I wonder, my question to you is really how confident you are in all of, we've had a lot of talk about subsidy-free renewables today, but how confident are you that that's actually going to become a thing in the GB market anytime soon?
So I think what I'd like to do is go back a little bit and just think about what the subsidy market has done for the UK renewables market. So if we go back to the long-term aim of NOFO, for those in the room who remember NOFO, NOFO is an interesting set of projects which basically, if you could bid into the auction, you didn't have to have a project particularly, you didn't have to have anything else, you had to be good at bidding. And what we ended up with a set of developers who were very good at bidding and then developing projects and flipping them to big companies, big VIUs, vertical integrated utilities. So that was kind of the model then. We then moved to the ROC market, which is the renewable obligation market, which was very much more a traded market. The idea was it was a market mechanism as subsidy. Keith and I have already had that debate. And essentially what you did is you brought in the traders at that point. So you then got traders coming into this marketplace. What was interesting with feed-in tariff is feed-in tariff then brought in a bunch of other players we hadn't then seen in this market. We brought in a bunch of small players. We brought in households. So we have 900,000 households in the UK that now generate their own power. But we also brought in a lot of developers who were very good at speed and planning. So what they did was they were incredibly good at working through the pace that the feed-in tariff was changing. So you had to adapt yourself to be that. And what was interesting, that those projects then got flipped mainly into the finance market, not into the utilities market. So we've kind of seen a changing landscape over the years in terms of how renewables have developed in this market. So I think what we're now going to see is another shift into this. And I completely agree. I think the key points are around capital, cost of finance. They're going to be about technology and technology costs, and they're going to be about integration and power value that you can get in this market. And what I'd like to do is think about it in two different slugs, actually. So if you kind of think about the large scale, you're going to have different evolving models coming through in the large scale than you go on in the small scale. First of all, because cost of capital will look very different at a small scale. The household cost of capital and the household perception of risk will feel very different to a merchant risk of a large plant. And so actually what you may see is a differential in terms of the adoption, in terms of small scale coming through, even though the costs might not be so good, the integration might be so good, and the trading might not be so good. You may have cost of capital that looks more attractive at that level. And then that competes with the larger scale sites where you've got much better purchasing power in terms of the technology costs. You've got potential better integration capability and trading potential. And you've got reasonably good finance at that level as well on large scale. So I think we might get a separated market where you see acceleration at both ends of the market, not necessarily one winning over the other, but both coming in at the same time.
Excellent. And in your business, you sort of, when we spoke about this, you were trying to describe to me how within Good Energy you were able to balance actually a really broad range of renewables, and you had some interesting statistics about the extent to which you cover your own demand with that.
So I mean, my vision for Good Energy has always been about the customer. So it's always been about trying to bring renewable energy into the customer. And so that's one of the reasons we look after about 140,000 households who generate their own power as well under our feed-in tariff services. But what we've always done is traded 100%. And I was surprised by the stats that my trading team came up with the other day, which is actually we balance that completely at 76% of the time. So we balance demand and supply. So actually, if we're trying to think about the gap that we're talking about, it's actually much smaller than a lot of people have thought about. And that's partially because you bring wind and solar in, and anybody who looks at a wind curve and a solar half-hourly output on a daily basis can start to see that they balance quite nicely together. Not always, but generally in the market. You then add some hydropower, you add some anaerobic digestion in there, and you begin to get quite a nice balancing position. We haven't added storage in. We're hopefully adding storage in for the first time this year. And I think that will begin to then shift that significantly. So we think that kind of balancing piece and that flexibility piece can be there fairly fast. I mean, the other parts, one of the forums earlier talked about the demand side response is not there in the domestic market. I completely disagree with that. So our view is that we've already seen a lot of demand side response that's driven demand reduction in the solar market, because the way that solar was deployed in the UK was much more effective than it was in Germany, because essentially you could do behind the meter balancing by the household. And that's what we've seen come through. And our studies have shown over the years that nearly 60-70% of people engage in demand side response just on a simple basis as soon as they put solar in technology into their homes.
So you mean they essentially reprofile their own demand to try and, when it's sunny, they turn things on?
And admittedly, that is your early adopters, so you'll see that coming through. But obviously, with technology enabled, that is a significant opportunity going forward.
Great. I suppose at the other end of the scale, to bring in Keith Anderson. So Keith recently became CEO of ScottishPower, previously CEO of ScottishPower Renewables, and obviously part of the Iberdrola group, which I think I had a look on for various stats on your website, but I think you've said that you're, as a group, investing 11 billion euros in renewables between now and 2022, which is a sort of staggeringly huge number, and Iberdrola has 29 gigawatts of renewables globally. So I guess my question to you, Keith, is, well, firstly, as part of a global group, where do you see the best prospects for subsidy-free renewables globally? And secondly, as a UK player as well, with a mix of thermal and renewables, how do you see that? How do you see a strategy evolving in the UK space?
Okay, right, thank you. So, we've been at this for quite a long time, the last 15, 20 years, getting to that position of about 30 gigawatts of renewable energy. We've got a great pipeline still, so we've still got a lot of investment going forward in onshore wind, offshore wind, hydro as well. And we look at solar and biomass and various other technologies. Still a lot of investment cases, a lot of prospects going forward. I think coming back to the topic about subsidy-free, and Juliet and I were having this conversation earlier, I hate that expression. And I can't understand that the renewables industry has become obsessed with talking about subsidy-free. And I'm not saying that because I'm some kind of subsidy junkie and I'm chasing subsidies left, right and centre. Absolutely not. But right now, in the UK, nothing in this industry is being built without some form of support. So why in God's name is it the renewables industry is running around desperate to be subsidy-free or desperate to talk about being subsidy-free? The network, the distribution system, thermal generation, nuclear generation, everything has got some form of support. Whether you want to call those subsidies or market mechanisms, you can have 101 definitions around it. But the truth is, if you're sitting looking at, as we are right now, building a £2.5 billion offshore wind farm in the United Kingdom, if you think I'm going to do that at market risk, then you're bonkers. Completely bonkers, because it's just not going to happen, okay? And the risk is, if we push and say that this industry has to be subsidy-free, and therefore the only way of building a project like that is you're out there chasing a PPA, a corporate PPA, then I think the growth rate in the industry will slow down dramatically. Because quite honestly, in the UK, I don't think that market exists. There are some corporates out there who will write PPAs. There's some possibility for it across Europe, but not enough to create a market for the build rate that we want, that the industry wants, the government wants at this point in time. Now, that might change in 5 years, it might change in 10 years, but it doesn't exist just now. So that's kind of the context of my comment about subsidy-free. I just think it's a strange topic and one that people seem to be getting massively obsessed about. I think right now the CFD mechanism has been phenomenally successful. I think it's one of the most successful mechanisms the government ever introduced. It's been far more successful than the renewables obligation. I think the RO was good at getting the industry kick-started. I think the CFD has been fantastic at bringing real competition into the auction process and into driving down prices and driving through efficiency. And you see that efficiency coming through. We like to think we're at the forefront of that process. I mean, we're building East Anglia 1 just now. That's at a price of 119, which sounds quite high compared to £57.50. But 119, it's the cheapest offshore wind farm being built right now. And the ones at 57.50 will come through. That's fantastic. I think we'll see the price come down further, partly because of competition, partly because of cheap money, partly because of technology improvement, partly because of logistics improvement, and partly because of all of the learning and the expertise that's going into it, and also because of the investment that's gone into some of the base infrastructure in and around the country in terms of port facilities and manufacturing facilities. So there's still further to go. But I caution people talking about subsidy-free or talking about a world where there's no kind of market mechanism to underpin investment risk, because certainly right now, at this point in time, I'm not aware of many companies who would go and say, I'm committing to spending £2.5 billion on an offshore wind farm, and I have no way of selling that power.
Yeah, sure. So it seems like, I sort of get that message pretty clearly.
Good.
On the offshore wind side, do you see a difference for say onshore wind and solar? There is a decent pipeline of projects there.
So look, again, I would do comparators. Who's out there building a gas plant just now? And a gas plant, in terms of a modular build, a gas plant's probably the easiest, quickest, simplest thing to build in terms of large-scale generation. Onshore wind's not a million miles behind it. No one's running around building them just now. And there's a capacity.
Not at £8.50 in the capacity.
No, exactly.
I mean, I suppose that depends. Definitionally, like, are we calling capacity market a subsidy now?
Well, okay, but this is the whole point. It's a mechanism that's meant to underpin the investment risk.
Yeah.
And it's just not doing it just now. And we're in a market where people aren't willing to go and put a whole lot of money at risk on the basis of a forward price that can be so volatile. So I think if you want that kind of large-scale investment to come through, if we want to move away from just having small-scale, really small-scale distributed generation, you need to be able to underpin the investment risk. And that has to be done at this point in time. As I say, the market might mature and it might change over a period of time, but not in the short term. So for onshore wind, again, you might see one or two small projects come through the system, but if you want this country to take advantage of its cheapest form of generation and see more investment go into the cheapest form of generation, then underpin it with a market mechanism. We and I know others, I think SSE were saying it earlier on today as well, we would love to see the onshore wind market be re-energised and reinvigorated. We think there's a lot of potential there to do it. And why shouldn't the UK consumers get the benefit of that cheap energy?
Yeah. Well, certainly,
now, again, what's a subsidy?
Yeah. Certainly, if there was a sort of pot one auction of that form, I'm sure it would achieve a very, very low price.
It would, yeah.
So to move on, I'll next bring in Will Gardiner, who recently became the CEO of Drax Group, previously the CFO in the same company. Drax, I think, does some really interesting brings out a lot of interesting narratives around renewables. So, for example, there was a piece you did recently saying that I think last year your stats showed that renewables alone produce more power than the total power consumed in 1958. Interesting kind of... Yeah. Oh, sorry. Stealing everyone's lines. Yeah. Anyway, but I think this is a kind of sort of staggering message around how the market's changing, and Drax is obviously a big part of that in generating from biomass. But I suppose my question to you, or Howard, just to sort of provoke a response, Drax seems to be the strategy is partly around providing renewable power in the form of biomass, but also then being the provider of flexibility. So there have been announcements from Drax around your position in some mostly GT developments and batteries and so on. So I suppose you're sort of looking at it from almost both perspectives and creating business models on both sides. So I wondered if you could kind of elaborate on that really. And I suppose just to put one fine question around that, to my point about system integration, who is it that's left on the grid providing inertia and kind of frequency response and all that good stuff around grid stability in a world where we have a very high penetration of renewables?
Yeah, okay. No, thank you. And maybe what I would just start with is maybe some of those stats around how this renewable revolution is actually happening, right? Because there's been a lot of talk about where it's going to go. But actually, last year, almost 50% of the power generated in the UK was generated from low-carbon sources. I mean, you've given my line about 1958. So it's, from our perspective, it's already very much happening. And I guess what I would say from a Drax perspective, we are very much big fans of all that happening, right? From our perspective, and I guess this comes a little bit to the question about subsidy-free, I mean, I think in some ways the story that I think we should be telling as an industry is how these subsidies have effectively enabled us to bring costs down over time, right? So I'll talk more about the whole idea of supporting investment as well, but I think that the idea that basically people take the subsidies and then go away and just use them and then it's just all about making money, that I think is a bad narrative for the industry. So I think for us to embrace the idea that they're fundamentally there to drive technology change, which I think is what has happened, I think we need to embrace that story. And one of the stories around biomass that we are actually, one of our big strategic objectives is, can we bring the cost of biomass down so that it's actually viable, and I hate to say it, but without subsidy, right? Because actually, and that is actually something we actually think we need to do, right? Because I think that, again, as the system goes forward, we may not get there, right? But again, part of the other theme, I think that large-scale thermal capacity of some kind will be needed on the system. Biomass is a great way to do that today. It is a low-carbon option for that. We get to 2027 when the whole system, again, the RO, the CFD expires. I think it still will be an important part of the system. And if we are demonstrating that we're making sort of the efforts to get the cost down, I think that will be, that'll put us in a better place than otherwise, right? But if I go back to this whole question of, grid stability, how does the system get balanced in this world with an increasing amount of renewables? First point I would make is it's already a growing problem or a growing issue, right? So the cost of balancing the system has gone up by about a third between 2014 and 2017. And it's now about £1 billion a year. Say, call it 3 million pounds a day, right? And that's a function of, while 31 gigawatts of solar and wind have come on the system, about 21 gigawatts of thermal has come off, right? So, and the thing, the unstated problem is that obviously you were getting a lot of this balancing, a lot of the inertia, a lot of the reactive power, et cetera, before for free. That now has to be, someone actually has to pay for that, right? And it's interesting to me, as I give an example, I mean, in those days, like when the beast from the east came through a few weeks ago, I think it's easy to understand how prices can spike and how balancing the system is more complicated. But you take there was a summer day in August of 2016. Take one specific example: a lot of wind, a lot of sun. 25% of that wind sort of is embedded, and actually the cost for National Grid to balance the system on that day was about £8 million. They did 4 times as much activity as they would on a normal day. Right? And so you can see the problem, I think, is not necessarily just in the intuitive times, but also in times, in different times as well. Right? So what are we doing, as you mentioned? So first point, biomass is a very good way, in a low-carbon way, to actually help balance the system and provide a lot of these ancillary services. And we would expect to be there doing that for the long term. But we also have projects to do 4 open-cycle gas turbine projects, and also we have a project to potentially repower the power station to actually convert it into a combined cycle gas plant, right? And I think, yes, I am a believer that the system will be more flexible. There will be less, large-scale thermal generation, but I don't think my own view is probably not as low as the projections that you guys are putting out there, because I think the system will need more of those ancillary services that we can provide, right? So what's happening now, and this gets to the question of, how do we actually get those investments off the ground? I mean, we've been very clear with the marketplace, in order for us to actually, commit to those investments, we need a reasonable contract in the capacity market. And, at £8.50 is not a reasonable price, right? Since you have this discussion with Dermot over lunch and you say, is your view of the capacity market bearish or bullish? Well, he's bullish, right? £8.50, that's a great price, right? For an investor, it's obviously it's more difficult, right? We think that there's actually what I would call a missing money problem, in the sense that the types of services that we can provide, ancillary services, we actually cannot contract on a long-term basis for those today. And the capacity market doesn't distinguish between sort of our capacity and a demand-side response, or an interconnector, for example, who wouldn't be able to provide those things. So we actually think that there's a need to actually, if the capacity market is going to be the mechanism that brings forward a lot of this new investment, not in the renewable space, but in some of this thermal investment, we think there needs to be changes there, right? So the first thing I would say is we very much look forward to participating in the review that BEIS will do of how the capacity market works. But I also would say, even in the shorter term, the whole question of interconnectors is a very interesting question, right? Because fundamentally, the interconnectors are, they're winning capacity contracts. They've already got a cap and floor mechanism, so they've already got an attractive, and I'll call it subsidy regime, right? Which is effectively supported their investment already. And then why are they allowed to, and I'll use the term double dip, when others are not, or being prevented from doing so? So I think actually we could look at the interconnector regime right now and say, look, again, another example. And one day, when the beast from the east was going through, the expectation that capacity might be provided by interconnectors, that's sort of what the derating regime in the capacity auction would expect. And what were they doing? They were flowing out to the continent. Not surprisingly, very cold day, right? So I think there's work that can be done more quickly, potentially around interconnectors, even in the next couple of auctions, to actually make some changes to make it more of an even playing field for those who want to actually build technology in the UK.
Yeah.
I think also that just with the interconnectors as well, they also don't pay carbon tax.
Well, exactly. Yeah. Another.
Yeah, we did some analysis on that ourselves recently, which pointed to interconnectors actually being viable purely based on the carbon price arbitrage. So they don't need the CM, they don't need the cap and floor at all, actually, in theory, and could still get away.
Although I would say that I'm glad the government has given at least some certainty around the carbon price in the UK going forward.
Sure.
So I wouldn't encourage them to make any dramatic changes there.
So finally, I wanted to bring in Tom Glover, who's the Chief Commercial Officer involved in asset optimization in RWE supply and trading. When I spoke to Tom about his participation in the panel, I was going to take it along the line of saying RWE becoming a company that's becoming more involved in thermal and trading only, and getting less involved in renewables. I was going to ask how a generator of that form is reacting to a world with more and more renewables, and ask you whether you might consider investing in renewables in the future as a company. But more recent events have suggested a change of direction, with the complex deal between RWE Energy and E.ON, with you becoming, again, an integrated thermal and renewables player. So maybe I'll just let you talk to that, and maybe outline where that's going, Tom.
Yeah, well, renewables. If anybody knows me, I'm always late to a party, but normally the last to stay. So probably the same in renewables as well. Yes, I thought I was coming here to talk about thermal generation until a week ago as well. But obviously now we will be, hopefully, if the transaction goes through, the third largest renewable generator in Europe. 60% of our EBITDA will come from renewables, maybe only 20% from thermal generation, so maybe 3 times more from renewables. So, I think that kind of tells you what a thermal generator needs to do in order to be viable for the future, probably, right? And you see Drax are doing biomass, we're doing biomass. I think you can't ignore the general trend. We've been quite open. It's not actually that surprising. I think we've been quite open about our views that more and more wind and solar is going to come on the system. What we were struggling with as a business was how to find a business model that was profitable in the wind and solar space, because what we found with things like CFDs was it was quite a game of can you get your CapEx and OpEx and financing low, rather than what we think we're probably, our key strength is understanding merchant risk, trading, risk management. And I think we mentioned before around, well, now we get to this point, and whether you call it subsidy-free, I also don't really like that, because I agree everything needs support, but let's call it more merchant risk being required to get renewable generators away. I think, that's where RWE can now have a key USP. We are one of the largest European traders. We're used to managing complex risk. We're used to managing balancing mechanisms, ancillary services. About a third of our income on our thermal assets comes from those sources. We believe it will come from renewable sources as we go forward, and combining a really good understanding of thermal with risk management and merchant risk management, together now with a very large renewables business, hopefully, if it completes, that really positions us, in our view, kind of with a real strong footprint for the future. But because you were going to ask me about the thermal stuff, I'll give that angle, because otherwise it's a bit too renewable. I mean, from our perspective, when we look forward, and I think I actually looked at your forecast as well, you need 60 gigawatts in our view of firm, flexible capacity in the UK in almost every scenario. Now that firm, flexible capacity can come from all sorts of places, right? It's DSR, whether it's embedded, whether it's rooftops, whether it's large thermal, whether it's nuclear. It's going to come from everything. That's the answer, and it's going to be a different mix. I think what's the challenge is for the thermal side of the business is the absolute step change in flexibility required. So if you look at that period where wind suddenly stops very fast and you need to suddenly ramp up your thermal, again, your modelling shows like 35 gigawatts in an hour flexible capacity required. So that's equivalent of turning on our whole gas fleet in an hour, right? I can tell you that's technically not possible at the moment. So we've got quite a challenge in terms of investment, and RWE will also continue focusing on this, is how do we invest to get our thermal assets to be able to do that when the wind doesn't blow and the sun doesn't shine. Some of the answer will be batteries. I think batteries are very suited to primary frequency response, really suited to it, and I think they'll just dominate that market. But the longer term issues aren't there. Biomass is definitely a real answer to that because it's storable. Yeah, it's a real possibility, and we're investing a lot in Netherlands on that, and Germany. Unfortunately, our plan in the UK just kind of went the wrong side of an RO sentence. Otherwise, we would have invested in the UK in that as well. But I think it's going to be a mix. I think the challenge for us is trying to work out where the money is in that mix, and where the value is. We believe there will be peaking plant. We don't necessarily believe CCTs are the right answer. We do have a CCGT project in case it is the right answer, but we've also got peaking projects. We've also got battery projects. We've got energy from heat projects. So I think the answer is all of the above. And that's how a modern generator needs to think, is there's not one answer. There's about 10 answers, and make sure you've got something in everything, and then overall we're not reliant on one energy source.
I mean, I suppose to throw it open to the whole of the panel then, this makes it quite hard for you as developers of projects, doesn't it? I mean, every year we go through the whole CM cycle, and sort of to Tom's point, you end up having to hedge your bets and bring forth all sorts of different opportunities all at the same time. Does that, it's like a slightly chaotic, just makes life very hard for you, I guess.
I mean, maybe I comment. I mean, a good example is our Tilbury Energy Centre, which we're developing. And on the same site, we're going to have plans for a 2,500 megawatt CCGT, a 300 megawatt OCGT, a 100 megawatt battery. And we'll make sure it's modular so we can do any of the above in any combination. And I think actually it reflects the uncertainty in the market. Some previous presenters said, we don't know the future. We would agree. And therefore, you need lots of options. As a trading company, that's what we kind of value the most, is optionality, so we'll create lots of them. It's not that expensive to develop sites compared to actually building them. So, I think you just got to hedge your bets.
Lisa. I mean, to me, it's a very interesting sort of comparison between what you guys have the balance sheet to potentially do and the risk management skills. Mm-hmm. And at one extreme, you've got the guys, UK Powers are trying to do small projects and get each one of them right. And I think it becomes very much incumbent upon the government to make sure that there is an environment that is stable and we can all live in and you can all count on, right? Because taking merchant risk is one thing, but taking merchant risk when the carbon price effectively sets the price and can be changed with the pen, that's a different sort of story, right? So it's a
how does that play out for a smaller company, smaller developer?
So I think one of the key things is you have to stay technology agnostic. So what you can't do is bet everything on one technology. And that's particularly, I think, coming through in the storage market, is that if you try and lean... So our play really is about being an integrator. It's about being technology agnostic, facilitating potentially behind the meter in the main, sort of for customers to become part of this market. So we're really focused at the decentralized end of this market, which means that we don't have to make that bet. Because if we try to make that bet, you're right, we don't have the balance sheet to do that. But there's other ways of doing it. So you can go down, if you've got a big balance sheet, then that's not a bad way to go. If you haven't, then you can do it in a different way.
So you're aggregating other people's projects, you're helping them manage their own energy, you're providing PPAs to even smaller, the smaller companies.
Yeah, and to be honest, that's the way we entered the market, because we couldn't get any credit lines. I sort of talked to David Gray earlier about when we entered the market, so anybody who wants to become a supplier today can just go and buy an off-the-shelf license, essentially. When we came into the market, I went to see Offer, if anybody remembers them in Birmingham. And I asked them for a license, and they said, that's fine, give us a business plan. Gave them a business plan. And then they said, can you give us 3 years audited accounts? And we kind of went around, but I'm a startup. No, we need 3 years audited accounts. So we kind of went round and round in circles. So kind of things have moved on since then. But still, that kind of, how do you get that entry into this market? And we're seeing a lot of the smaller suppliers kind of just fly straight in there. In terms of going forwards, the agnostic piece, I think, is really important for the smaller side. And that's what you're going to see coming through at that end.
Excellent. Well, I'd just like to thank all the panelists for what I think has been a really interesting session. We at Aurora, as we've said, we're doing a lot of analysis around this, principally or particularly to understand the nature of merchant risk for renewables and to understand price cannibalization and new emerging business models. And you'll hear more and more from us on these sorts of themes over the coming months. But anyway, thanks a lot for coming to the session. And if we can just show our appreciation for the panelists in the normal way.